And
You know,
this
also,
is
Maybe 4 to 6 weeks, I'd say. Go
yeah.
ahead.
I was just gonna go, since we're on the topic of the IRS slash government entities and everything, and I'm sure a lot of the new individuals to this group and to this process are going to be wondering, since the change in government, what do you see with new regulations going to be rolling out and the winds where the market's going to be shifting? So I've got a lot of insight saying that the market's going to be shifting. It's just specifically in the healthcare, closer to telemarketing and home health.
Right.
And there's just going to be a lot of regulations that a lot of the lower to middle market just can't swallow the costs, which is going to lead to a lot of the mergers between the massive hospitals, etc. But I would love to have your insight on that and some of the emerging markets and anything from HVAC to whatever that could be hot coming out of COVID.
Wow. All right. That's a big question. And as far as regulations, though, I think you also need to know what we have in
that
mind.
wait, real
Go ahead.
quick, Bill, that's Sam. We call him Captain America, but he just came home, United States Marine.
Wow. Oh,
About to
wow.
be a captain, so future president of the United States. No joke. Just to give you a
Wow.
background on who Captain
Wow.
America
Well,
is.
honored to meet you. Honored to meet you. And thank you for your service. So let me say that. But yeah, as far as I mean, regulation, I think you also got to talk about taxes too. So I'll try to hit both of those things. I mean, and as a CPA, of course, taxes are probably top of mind. Um, and the thing with the stimulus is it's wonderful, but ultimately it has to be paid for. You can't just sustain deficits. You know, I mean, it just isn't going to work. Because it's going to have to be paid for, and our new president has been very clear about who's going to pay and how. And one of the changes that would radically affect deals would be the increase in the double tax rate on C corporations. Because up till now, I mean, starting, especially with the 2017 Tax Act, C corporations became very popular because basically the double tax was reduced pretty much to almost equal to individual ordinary tax rate. It's about 39%, 39.8 on the C corporation double tax. So if that's the worst case in owning a C corp, people would go for it because the best case is you only pay 21%, and then under Section 1202, as long as you check some boxes like the right industry, the right hold period, stock deal at the end, pay zero on your gain as a small deal. So it was a wow. I had people that were starting up, their holding companies as C corps, to take advantage of those provisions and the low tax rates. Now, what the new administration, though, has made very clear is that, for one thing, they're going to increase corporate tax rates, but only halfway to where they were. So it had been 35, went down to 21, now it's going to go to 28. So that's that part, okay, that's fine. However, if you calculate that out, that will be like an immediate 10% decline in value of companies that are paying 21 versus 28. So that's everybody on the stock market. That's like a 10% valuation. If you're valuing your stock portfolio on a PE ratio, bang, 10% gone. Okay, so that's one thing. But even worse than that for the middle market people that are trying to do C corporations is that the double tax rate, which is basically the rate on ordinary dividends and qualifying ordinary dividends and capital gains, instead of 20%, is now going to go up to the new individual rate, which is really going back to the old rate, which is 39.6. And if you do that and you recalculate the double tax, you're at almost 60%, and that's just on federal. So it's like a majority of your dollars is gone. If you're exiting your business, a majority of your dollar is no longer yours. So that could have a massive effect on entities and just kind of the whole thought of going forward. And I've written articles on that, which I've tortured Nancy with. So if you want to see those, I'm happy to send them. So that's the tax side. As far as regulation goes, I'm not sensing really pending doom. I mean, I've done so many healthcare deals now, and it's such a hot space. So, for example, I helped a company do a roll-up of dental offices, and it was announced. It's an announced transaction, so I can't even say who it was. It was True Dental. It was in Southfield, Michigan. They built like a portfolio of, I don't know, probably 30 dental locations they did through a roll-up, and I was with them from the beginning. did all their audit work, all their tax work, and then also did a sell-side QB. They wound up selling the KKR. I can't tell you what the number is, but it was astronomical. So they really were an overnight sensation after 5 years. So that worked out very well. In addition, though, I'm working on a healthcare SPAC right now where we're rolling up substance abuse, we're rolling up behavioral health, we're rolling up compounding pharmacies, and that is already raised $280 million, already committed to the SPAC. So I'm seeing everything hot about healthcare, so I'm not seeing any pending doom or slowdown there. So, I mean, as far as regulations, I think one of the worries originally was, well, what would the Trump administration do with Obamacare, and what would they monkey with here, and what kind of uncertainty there would be? And obviously, now that the administration's changed, as well as Congress is now blue, pretty much. You don't have that type of concern anymore. So I'm not seeing a lot of slowdown. I'm seeing quite the contrary. I'm seeing a lot of deals and a lot of money flying around, for these deals. So, and again, I guess maybe I'm not as focused. I mean, there was something that actually, though, came up on substance abuse, which was interesting, and it even affected. I have a nonprofit I service here in Chicago called a McDermott Center. They're like a $30 million nonprofit that do detox and substance abuse treatment, and it's nonprofit. They had the same problem as this. Basically, what happened was, and this can happen at any time, the funding sources, your insurance companies, certain of them changed their reimbursement model. What they had been doing for substance abuse was they would pay you for each test you did. So you'd have your own test lab and everything, and you'd be able to bill them every time you went in and did a test on one of these folks. They switched it to being part of the pure diem rate, and basically cut the EBITDA of the company before my client bought it from whatever 18 million EBITDA down to like 5. It was like bang. So there's always, whenever you have whenever you're dependent on payer sources, there's always a risk that they're going to change how they do things, and that's basically what happened in that industry. Was suddenly, people decided, well, that's part of your per diem rate. We're not going to pay you for that separately anymore. And all of a sudden, this huge profit center they had is just bang. It's gone. So there are always, those types of things. But as far as specific regulations, I'm not seeing any that that are affecting the deals I'm working on right now. And I mean, maybe you could clarify what type of stuff you had in mind, because I might have heard of some of it. If you're still
it was
there.
just regarding the payments with Medicare and Medicaid, and the re-up of the Affordable Care Act, and how that was going to impact the market. Because the way it was explained to me was that basically, I know that healthcare primarily relies on Medicare and Medicaid, and it takes up about 35% of the revenues of hospitals. And then you have basically service based on operations, and then depending on if it's an assisted home, etc. But with how that payment was being handled, and then hospitals not getting reimbursed and having to work at a deficit as compared to being or giving or getting insurance money from like Cobra, Blue Cross, Blue Shield, stuff like that.
Oh, interesting. Because, the nonprofit that I deal with had a huge problem opposite way with Obamacare.
Mm-hmm.
Suddenly these indigents, of course, they're bringing in people that are homeless and everything. They're a nonprofit. That's who they're treating. They're picking people up off the street. But the thing is, a problem they had was kind of the opposite problem, which was because these people theoretically qualified under Obamacare, they weren't getting the grant money anymore. It was like, okay, well, you're supposed to go out and get private insurance, and just think about, you need a social security number and stuff. You need to kind of have your ducks in a row to get that insurance. So they were having trouble, even getting reimbursement. I mean, it was like all of a sudden the grant money that was there, they're telling them go to private insurance for this, and to try to get private insurance with people that don't even have an ID. It's like it didn't really work very well. But no, that's an interesting one. I mean, and I'll see, again, I'll see what more I can find out about that, but haven't seen it on my deals right now. I just haven't seen that as a major issue. But that's an interesting thought, and I'll pursue that. You bet.